This paper is investigating the returns of the inventions of green technologies on firms' market value using a sample of European listed firms. It draws on three main streams of intertwined literature: that on the market value returns of innovation, and precisely that on the profitability gains that may stem from the generation of patents. We know that patents grant exclusive property rights that allow firms benefiting from temporary monopolistic power, but also we know that patents may serve as a signaling tool of available knowledge assets for the firm that may protect firms from competition, but can also raise firms' prospects of future cash flows, thus increasing the expected profit margins and increasing firms' market value. Then it draws on a second stream of literature that on the whether or not it pays for the firm to be green. And lastly, it draws on the literature on the competitiveness returns of environmental regulation that is known under the so-called Porter hypothesis, according to which stringent and well-designed environmental policies can stimulate innovation on the one side and competitiveness on the other side. So the main aim of the study is that of understanding which are the effects of green technologies generation on the stock market, but also the second aim of the study is that of understanding if and how environmental policies can drive those market values returns. The expectation is that stringent environmental policies can induce polluting firms to improve their environmental performance by innovating, and this can also potentially create a new market for upstream firms that are serving as suppliers for green technologies, other downstream firms that need to innovate in order to cope with the new policy. So in other words, we test whether environmental regulation, can create a derived demand for environmental technologies in those downstream sectors that upstream firms may commercially exploit. Our results confirm the main expectations that we had. The more the green technologies are generated by a firm, the higher the market value return associated, and we measure the market value return by means of a Tobin's Q index. But also, we find that in contexts that are shaped by stringent environmental policies, here in the paper measured by means of the OECD Environmental Policy Stringency Composite Indicator, so in context shaped by stringent environmental policies, the suppliers of green technologies and their green knowledge assets are positively evaluated by markets. When testing for the moderation effects of environmental policies on the green technologies returns, we do find support that the higher the growth of environmental policy stringency, the stronger will be the market value return associated to the green technologies generation. These results get also confirmed when we explicitly account for the quality of the knowledge assets the firm possesses by means of forward citations received by its patents. So the main argument of the study got supported. Market positively evaluate firms that generate new environmental technologies, and this effect is stronger in contexts that are characterized by stringent and growing environmental policies. So the main policy implication of the study is not only that stringent environmental policies are not necessarily detrimental to firms' competitiveness. This is something that we already knew from the Porter hypothesis, but also that those environmental policies may set the direction of technological change, may guide and stimulate firms to innovate respecting that direction. And in particular, this policy stimulus can help upstream firms exploiting new competitive advantages in those markets by serving the new derived demand for green technologies that the policy has generated, leading to positive stock market returns. So in other words, these results can help explaining a bit more the mechanism by which environmental policies, of course under certain conditions, can lead to win-win solutions that would allow decoupling environmental pressure from economic growth.